Welcome to this explainer. Today, we are breaking down a truly fascinating analysis of an imminent monetary policy shift. According to financial and tax analyst Marcus Graves, the federal government is preparing a move that will turn conventional retirement advice completely upside down. It's a bold claim, for sure, but the evidence we're going to look at is incredibly compelling. Let's dive right in.
The entire analysis centers on incoming Federal Reserve Chair Kevin Warsh. During a recent Senate testimony, Warsh dropped a highly unusual, very specific phrase: financial repression. He literally detailed a comprehensive debt reduction framework that he called the only mathematically feasible path to handle current federal interest expenses. So yeah, this is a massive deal. It signals a monetary strategy we haven't seen in over 4 decades.
To really grasp what's going on here, we first have to define financial repression. Simply put, it's a deliberate policy mechanism. Think of it like this. The Federal Reserve and the Treasury essentially team up to keep nominal interest rates, the actual rates printed on your bank statements, artificially below the real-world rate of inflation. Mathematically, this forces savers to lose purchasing power while simultaneously shrinking the real debt obligations of borrowers. It is basically an invisible tax on your cash.
And here's the crazy part. This isn't just some theoretical economic experiment. This is the exact playbook the United States has used before to dig out of a historic debt crisis. Consider the timeline from the post-World War II era. Federal debt peaked at a whopping 121% of GDP back in 1946. Over the following decades, by suppressing interest rates below inflation, everyday savers quietly absorbed those costs. Fast forward to 1974, and that debt had plummeted to roughly 30% of GDP. And they pulled this off without the government ever actually paying down the principal.
So, why are we talking about this right now? Well, because there is a critical ticking clock. The analysis points out a hard deadline, arguing that retirees have exactly 30 days to act before May 15, 2026. That happens to be the precise day the new Fed chair takes over, and this whole historical framework formally kicks back into gear.
Section 1. The Paradigm Shift: Winners and Losers.
The source makes a genuinely shocking claim here, basically doing exactly what financial advisors have been telling us to do for the last 40 years. It's about to become a guaranteed losing position. Conventional wisdom says you pay off your mortgage early, you keep high cash balances for safety, and you buy long-duration bonds. But under a financial repression reality, you literally do the exact opposite. You hold onto that mortgage, you buy TIPS and I-bonds, and you avoid long-duration bonds like the plague. Let's put some faces to this to see how this massive shift actually plays out. Take Patricia, sitting on $81,000 in cash savings. Under these new rules, she becomes a structural loser. But then look at Robert. He's carrying a $140,000 mortgage at 3.2%, and he becomes a structural winner. Meanwhile, Joyce with her super conservative CD ladder, and David with his long treasury bonds, they are both engineered to be losers under this new system. Everything completely flips upside down.
Let's zoom in on Patricia's situation for a second to really understand this invisible wealth transfer. She's got a high-yield savings account, earning a 4.2% nominal interest rate. Sounds pretty great, right? While not when the Elderly Consumer Price Index, which tracks inflation for her specific demographic, is running hot at 5.7%. When you do the math, her real return is negative 1.5%. Her actual purchasing power is permanently shrinking every single year. It's transferring her wealth straight back to the government.
And that brings us to what might be the absolute most counterintuitive takeaway of this whole explainer. Playing it conventionally safe under financial repression is actually the structurally riskiest position a retiree can possibly hold. Stashing cash, buying CDs like Joyce, or hoarding long-duration bonds like David, those positions are actively engineered to lose anywhere from 30 to 50% of their real value over the next 10 years.
Section 2. The Repositioning Playbook. Let's talk about how to protect those assets.
To survive this shift, the analysis breaks down a highly specific 5-step repositioning sequence. The mission here is clear and incredibly urgent. You've got to move your assets out of historically safe categories and get them safely tucked into inflation-indexed havens before the rules officially change. Let's walk through exactly how this works step by step. The first big moves are all about auditing and rethinking your debt strategy. You need to calculate your total fixed income exposure, which for most retirees sits dangerously high, usually between 60 to 90%. Next, and this is absolutely crucial, immediately stop making any accelerated payments on low fixed-rate mortgages that are sitting below 5.5%. Why? Because a fixed-rate mortgage is frankly the single best asset you can hold as inflation rises. The real value of what you owe is literally dropping, but your monthly payment stays exactly the same. You're going to want to take those extra mortgage payments and redirect them elsewhere.
So where do you put that redirected cash? That's the inflation protection strategy. The source advises moving that money straight into Treasury-backed Series I savings bonds or TIPS. Unlike your standard bonds, these instruments automatically adjust upward as inflation rises. Also, you absolutely need to call your plan administrator today to verify if your pension has an automatic inflation adjustment, just like Social Security does. If it doesn't, that pension is going to rapidly lose its buying power, and you definitely need to plan for that.
The final piece of the puzzle is systematically selling off those long-duration bonds. But listen, there's a huge caveat here. You can't just log in and dump everything tomorrow. Doing this safely usually takes about 90 days to fully complete. The strategy is to start in your tax-advantaged accounts first, moving in careful, calculated stages so you can properly manage your capital gains exposure.
Section 3. The generational loophole.
Before we wrap this up, the source highlights a highly specialized strategy hidden deep in the tax code that actually turns this whole inflation burden into a major advantage. It relies on Internal Revenue Code Section 135. This little loophole lets retirees completely bypass federal, state, and local income tax on I-bond interest. Here's the play. You purchase I-bonds in your own name. You hold on to them until your grandchild gets close to college age. Then, you redeem those bonds specifically to pay for their qualified tuition and required fees. If you follow those steps to the letter, every dime of interest you earned is completely tax-exempt.
So what kind of numbers are we actually talking about here? Well, by using this loophole, the projections show an inflation-hedged, totally tax-free return of 5 to 7% annually over the next decade. Literally no other retirement instrument out there can match that level of tax-efficient wealth transfer under a financial repression framework. It is just a massive leg up for anyone who knows how to use it. As that May 15th activation date looms closer and the era of conventional retirement advice seemingly comes to a close, it really leaves us with one critical, urgent question. If the rules of the economy change tomorrow, is your current retirement portfolio structurally engineered to win or to lose? It's a thought-provoking challenge to everything we've ever been taught about saving and debt. Thanks for tuning into this explainer. I really hope this breakdown helped clarify what is definitely a complex but crucial shift.